Thanks, Jason, and a very warm welcome to everybody this morning. Today I wanted to share some reflections of the global insurance landscape and the impacts on the industry, both locally and globally. We're now into the fourth year of insurer remediation for some product lines in Australia, and finally market conditions are starting to improve, albeit in pockets. Indeed, this has been the longest consecutive period of positive property rate increases we've ever seen. So some really welcome signs for buyers emerging. We've seen significant shift to stabilization of pricing in the US and the UK in recent months, driven by new entrants and growth expectation, following a sense that portfolios have been largely corrected. And pleasingly, premium rate movement in some areas is starting to stabilize here too, and particularly the more vanilla exposures and occupancies, well-managed risks and risks with a low natural catastrophe footprint. Other areas, on the other hand, such as cyber, some elements of casualty, professional indemnity, complex property, remain significantly challenged, and this divide will become all the more pronounced over the coming months. This said, coverage is still being heavily scrutinized, and a number of restrictions are being imposed across the board. Infectious disease, silent cyber exclusions, and limitations for contingent business interruption are being mandated by the majority, if not all insurers, and often with little or no flexibility, largely driven by reinsurance requirements. So what is driving this start of stabilization? Well, that's a really interesting question, as many of the factors that led to the market conditions changing 4 years ago remain in place today. The 18 largest global reinsurers forming part of Aon's reinsurance aggregate have recorded an average combined ratio of 94% for the first half of 2021, an improvement from a full year result of 103% last year. And this was attributed to lower expense ratios, lower attritional loss activity, as well as much of the claims activity of COVID-19 falling into the 2020 year. And whether this plays out into the full year results will largely be driven by the US hurricane season. And to date, unfortunately, the signs for this are pretty ominous, with losses close to the 10-year average at just the halfway mark. So reinsurers are really watching this very closely. Hurricane Ida alone, is expected to cost more than $31 billion US, for example. One major factor in market stabilization is the continued growth of global capital. Importantly, for the first time since 2017, both alternative and traditional capital have both grown simultaneously. There have now been 4 consecutive quarters of growth in alternative capital, and particularly the cat bond space, which is creating some really welcome competitive tension. This said, questions surrounding the sustainability of these results, is under question, as insurer margins, whilst improving, remain extremely thin, and the positive impact of lockdowns on loss ratios is still largely unknown as people come out of that environment. And whilst this is all generally positive for buyers, there are some challenges ahead for capital providers that simply can't be ignored. And whilst this isn't an exhaustive list by any stretch of the imagination, I have tried to put forward some of the challenges here. The first is internal disconnects, which are emerging within some insurers. So insurer growth expectation is mounting again as carriers look to build on stability they've created, but it is taking time to translate into new underwriting practices, especially considering the prolonged period of remediation focus that we've seen. They continue to be challenged by underwriting teams that are fearful of writing just too close to the underwriting guideline boundaries that they've been set. The second element is volatility, and this has started to become a dirty word. As carriers start to once more focus on growth, there's an almost complete alignment of insurer appetite, driven by the need to reduce volatility, something that buyers feel is the exact role that they require of their insurer partners. And this makes some industries and product lines hugely attractive to all, whilst others are borderline uninsurable. There's a growing disconnect between the experience of a waste recycler and a retailer, for example. And not only does this frustrate buyers on the wrong side of the ledger, it also stifles innovation at a time when buyers need it most. And the third challenge is the fact that despite significantly improved conditions for insurers, they've largely failed to address profitability. Again, Aon Reinsurance Aggregate have recorded an average combined ratio of 102% and a return of just 5% in the past 5 years to the end of 2020. So capital providers are continuing to underwrite to a loss despite successive years of favourable market conditions. A record low interest rate environment hasn't really helped either. Not only are capital providers more demanding of their returns, so too are the regulators pushing capital providers to have predominantly safer securities and bonds in their investment portfolios. This said, things are looking up with better underwriting results and strong investment return in the first half, driving significant rebound in return on common equity, as we can see in the graph here. And time will tell whether this reflects things to come or whether it's, it's an anomaly, but certainly a really positive step in the right direction. So putting investment income to the side for a moment, why aren't capital providers swimming in profit once more after 4 years of remediation and heavy pricing increases? Well, we put it down to 4 key areas. The first one is claims inflation. So since 2019, there's been a 300% increase in the frequency of verdicts of $20 million or more. In the US, court-approved class action settlements reached $4.2 billion in 2020, up from just over $2 billion a year prior. And this is largely as a result of several mega settlements in excess of $100 million. But this claims inflation isn't just tied to long-tail lines. It only gets worse for property and construction, for example, with emerging inflationary pressures. US inflation is now above 5%, and according to the Australian Bureau of Statistics, on average, the construction costs across Australia have increased by 3.25% over the last year. And this increases to as much as 17% for housing construction in Western Australia, for example. And increased rebuild costs are going to impact loss ratios and are going to challenge existing insurer models. The second element here is an increased frequency in natural catastrophe events. And whilst the US continues to bear the brunt of the global natural catastrophe losses, APAC certainly punches above its weight in terms of a 10-year average, and in fairness, largely driven by events in 2011. And whilst these were true catastrophic losses, as time's gone on, we've seen the emergence of a new trend, the mini-cat. And these are events that largely go under the radar, but breach the $1 billion US dollar mark. In 2020, there was a record 28 of these events globally. And it's these events that are impacting the continued growth in claims in Australia and the broader region. And many of these risk types, such as hail, bushfire, storm damage, and more recently tornado, are really difficult to model. And the east coast of Australia is seeing a particular rise in frequency and severity of these sorts of events, making insurers increasingly wary of them. Indeed, we need to ask the question, do insurer models reflect the climate that we're facing today, or has the pace of change in climate outdone their models? Well, interestingly, S&P believes so. They've just released a report suggesting that reinsurers could be underestimating their exposures to natural perils by as much as 50%. And finally, within the Pacific region, heavier local regulatory pressure will likely start to drive expense ratios as insurers prepare for increased cost to serve under revised legislation. And whilst return on equity for the first half of 2021 may have risen close to the 15% long-term requirement that they set, it continues to underperform the S&P 500. And if you add these emerging factors into the mix, things start to get a little bit more interesting. And it's fair to say this could only get worse if rates do stabilise as we're starting to see. Whilst perhaps a really pessimistic view, we do feel this could lead to any stabilisation being short-lived. This all said, there are some counter-arguments to this thinking. The European Union recently announced 120 billion euro reduction in capital requirements for insurers under Solvency II, in an attempt to help them repair after COVID-19 and for them to meet climate goals without eroding policyholder protection. And it's fair to say that the things like this will certainly help. Another is the changing buyer behaviour. As capital providers struggle to provide the risk transfer options historically available, buyers' views on the relevance of risk transfer to their ever more complex needs is really starting to shift. There's growing buyer frustration and a market fast losing relevance is real. In this graphic, we show insured losses as a percentage of GDP in the US continue to reduce, reaching levels not seen since the 1970s. And at the same time, the global protection gap, which is insured versus economic losses for natural catastrophe perils, sits at a record 64%, or a whopping $174 billion US dollars. And if we add the acceleration of exclusionary language into the mix, this number and overall relevance will continue to fall even further. So how can buyers make better decisions amongst all of this uncertainty? The challenging and unpredictable market conditions, combined with emerging risks previously not considered, have certainly refocused buyers on the value, the structure, and the overall cost of the insurance programs. The makeup of your risk transfer spend is evolving. In most cases, buyers will be faced with decisions around how to manage an ever-expanding and complex risk transfer need. It's never been more important to focus on total cost of risk rather than risk transfer or premium cost. And over the past 12 months, we've seen a large uptake in clients exploring captive or sell solutions to manage increased retentions, to create a bridge to parametric solutions, or simply to access additional capacity via the reinsurance market. And these are absolutely the right solutions. But whether you intend to set up a captive vehicle, you may already have one, or if you've got no intention of doing so at all, there are some important stage gates to ensure that the right decisions are being made. Firstly, set your risk tolerance and appetite at a portfolio level rather than setting it per product. All too often we see large clients retaining millions of dollars on a property or a casualty policy, and then they look to retain $1,000 for a motor policy, or they take out a computer equipment policy for a bunch of laptops. In our view, this is premium that could and should be consolidated and leveraged as premium to build scale within a captive vehicle. Secondly, try to make decisions before market engagement has even commenced. Yes, there'll be elements that will need to be weighed up after terms are negotiated, but making educated decisions based on the likely outcomes will maintain your control rather than market influence, and particularly around the timeliness of terms. All too often, decisions are taken away because of a lack of time at the end of the process. Try to engage carrier partners who align with your values. As we heard yesterday, ESG is becoming ever more important, for us all, and insurers are no different here. If buyers align with those that share similar values, you will ensure a more sustainable relationship, and therefore more certainty over time. And if you are going to think more aggressively around risk retention to reduce your total cost of risk, how can you improve risk management practices to build your resilience, making sure that you're focused on those areas that can have the biggest impact? Try to think more broadly beyond the pinch points and bottlenecks you focused on historically. Think about your business model and how it's changed. What have you learned from COVID-19? As technology improves and ESG starts to dominate boardroom decisions, have you challenged the point in which you would consider not reinstating an asset, for example? And as you consider these questions, think more broadly about risk transfer than focusing on the renewal of your expiring insurance policies. And then finally, get technical. Talk to the Aon team about the tools available to help you. And just one of these tools at your disposal, for example, is the Risk Financing Decision Platform, or RFDP. RFDP is an analytical solution designed to help businesses find the optimal insurance program structure, and it consists of three basic modules. The first is risk appetite, which establishes an organization's willingness to retain risk and sets a constraint when we're looking to optimize programs based on the total cost of risk. The second is loss and volatility modeling, where we start to build detailed actuarial models of the risk exposures based on the organization's claims data and our knowledge of market pricing techniques. And then finally, program design enhancement, which uses the actuarial models that we described to compare the total cost of risk across available risk management and insurance program options. And it's this final step that allows us to combine the technical analysis of the organization's claims experience with our insurance market expertise to identify the most efficient insurance program. This involves examining the total cost of risk at different return periods to determine, the trade-offs between different program structures. I'm conscious that I've covered off a huge number of topics in a pretty short space of time, but in conclusion, the industry needs to do more to adapt and remain profitable against changing client need, climate change, and increased regulation, whilst trying to maintain relevance and really addressing the underserved. Not easy by any stretch of the imagination, but in the interim, buyers can play their part by becoming more resilient, looking at total cost of risk rather than focusing on risk transfer pricing, improving data and submission quality, including improved insurer discussion and understanding your emerging risks before it's too late. So a huge thanks to all of you for listening this morning. Please reach out to any of my Aon colleagues if you've got any queries. I just wanted to, wish you all, a really good day, and please, enjoy the upcoming sessions, for the rest of the day that's coming up. Thank you.